Hi, this is Matthew Cratter from Trader University. And in this video, I want to show you how to trade earnings, how to trade a stock's earnings. I'm going to show you two different strategies, and I'm also going to show you how we can profit from a stock going up after earnings and going down after earnings. Now, the first stock we're going to focus on for our systems is a company called Veeva Systems. They're a cloud computing company focused on pharmaceutical and life sciences, and the ticker is VEEV. Now, the way this strategy works is we don't like to step in front of earnings. We like to trade a stock after it's already reported earnings. And we'll know whether the earnings were really good or really bad based on how the stock moves after earnings. So Veeva is a great example. Just reported on May 30th, 2019, just a couple days ago. And you can see it gapped up after reporting. It reported the day before. Next morning, gaps up very, very strongly. And you can see it's trading at all-time new highs here. It's gapped up right over here. This is a 15-minute chart, so we're looking at 15-minute bars. So you want a stock that's reported earnings, and you don't personally decide whether the earnings were good or bad. You need to let the market decide, and the way the market will tell you its conclusion is based on whether the stock makes a strong move up or down. So what I like to do is I like to wait, let the stock trade. So let's say it reported earnings the night before or early in the morning. I like to let the stock open up and trade for 15 minutes. And that's what this first bar is right here. It's a 15-minute bar. And then I like to go long right at the close of that 15-minute bar. So if you're trading New York time, this would be at 9:45. You'd go long the stock. If you're trading on the West Coast, you'd let the stock market open up, let the stock open up at 6:30, and then you'd go long at 6:45. And again, we're only going to do this for stocks that are gapping up, at least to seeing all-time new highs is really nice, or you can just look for new 20-day highs. So what I do is I go long right at the close of this bar. So I put in a limit order right at that closing price of that first 15-minute bar, and then I put my stop loss right at the bottom of this bar. So if the stock trades below this bar, this low of this first bar, then I know I'm wrong and I will exit. And then what I do, if you want to do this as a day trading strategy, you can just hold until the end of the day. And so you would exit right on the close of the market. Now, what you could also do is these kind of stocks will often continue to move in the same direction for many days afterwards. And the reason for this is because you have institutional investors who have to buy millions of dollars worth of stock, and they'll be adjusting their position. In this case, they'll be adding to their Veeva Systems longs. And as a result, they're going to continue to move the stock up. They can't just get in and out of a stock in one day or in a couple of minutes like you or I can. When you're trading millions or even billions of dollars, you have to slowly work your way in. And this will cause something that's called post-earnings announcement drift. Post-earnings announcement drift, PEAD. And we can see it happening with Veeva. This was the day right here where they reported earnings. And so a way to trade this is you can hold on to that day trade that you entered at 6:45 or 9:45. Or you could also just enter at the end of the day and then play the drift as the stock continues to move higher. Sometimes stocks like this will continue to move higher for a few days or even a few weeks as a result of post-earnings announcement drift. This is a well-documented stock anomaly and one that I like to profit from. So depending on your strategy, you can exit right here at the end of the day, or you can just keep swinging it. And as you can see, the stock is just trading at all-time new highs as we're speaking right here. And you can sort of use a trailing stop as you trade this. So you might, at the beginning, keep your stop down here, and then you might adjust your stop, move it higher as the stock moves higher. And so you can sort of lock in profits. At a certain point, you can even do a break-even stop where you don't let it trade below where you entered it. It really depends. And likewise, if you're doing a post-earnings announcement drift for a day like this, you could set your stop loss right at the low of this first bar. You enter here at the end of the day, and you bet on the stock continuing to drift higher. And if a stock's chart looks like this, where it's hitting new 52-week or all-time highs, and it's also, if we scroll out, you'll see it's been in a very nice uptrend. The stock itself is trading above the 50-day moving average, which is this blue line here. and the blue line is above the 200-day moving average. This is a classic uptrend, and when you're dealing with post-earnings announcement drift on a stock like this, tends to work out quite well. So this is how we would trade a stock after earnings from the long side. This is ViV Systems. Now let's look at a couple shorts. So Abercrombie & Fitch, ticker ANF. Let's first look at the daily, the intraday chart. And what you can see here, again, it's the same 15-minute chart. You can see Abercrombie reported earnings after the bell. It looks like it was end of the day, May 28th, when the stock market was closed. Reported earnings, and we know it was a very bad report or very bad forward guidance. The reason we know that is the next morning it gaps down. So again, we don't decide, maybe they beat by a penny or something, maybe they beat by 10 cents. We don't decide whether an earnings report was good or bad. We let the market price action tell us. Because oftentimes the stock will beat, but then the forward guidance will be bad, and as a result, the stock will gap down. So this would be an example of how we would trade after earnings with the stock gapping down. And it's pretty much the inverse of what we were doing before. You look for a stock that is gapping down either to new lows or to new 20-day lows. You can see Abercrombie's really been in a downtrend here. And what we do is we would actually go short rather than going long at the end of that first 15-minute bar. So we let the market trade, let the market open up and trade for 15 minutes. And then we would go short, which means we would borrow the shares from our broker, sell them, and we'd be betting on the stock trading lower. And then after the stock trades lower, we would buy the shares back, deliver them back to our broker. So if you make money buying a stock, you buy low and sell high. If you're shorting a stock, you want to sell high and buy low. So it's sort of the inverse, and it's a way of betting on a stock going down. Again, this is a little more of an advanced strategy, and your broker has to let you sell short in order to do this. But it'd be very similar to what we did before, where you go short, let the market trade for 15 minutes, let the stock trade for the first 15 minutes, go short, set your stop at the high of that first 15-minute bar, and then you can close at the end of the day, which would be right here. And you basically let it drift lower. Now, you can turn this into a swing trade or multi-day trade by just holding on. And again, you'd use sort of a trailing stop, as we talked about with ViV. But in this case, we're betting on the stock going down. You can see this is a very good example. This is, again, ANF. We're looking at a daily chart here, and it's sort of the inverse of what ViV looked like. We have the stock trading below its 200-day moving average, below its 50-day moving average, and this huge gap, which is very bearish. This was obviously when they reported earnings. So another way of trading this is you can enter right at the end of the day on that gap down day. So in this case, we'd go short right at the end of the day. You can set your stop at the high of that bar, or maybe in the middle of the bar, depending how much volatility you're willing to endure. You go short, and then you let the post-earnings announcement drift take you lower. And in this case, what's happening is institutional investors will be dumping the stock and or shorting it. And again, they can't do that all at one time. So they're going to do it over multiple days, which is going to let the stock continue to drift lower. So this is a nice, if you don't have a strong view on the market, whether the whole stock market itself is going up or down, what you can do is you can do a couple of these earnings trades. And again, we always wait till after the earnings comes out and we see the reaction. But if for example, we're long ViV and we're short ANF, we sort of have some offsetting positions. And so in this way, we're betting on one stock going higher, another stock going lower. Now to close, I'll give you one last example. Another retailer, CPRI, Capri Holdings. They did something very similar to ANF. They reported earnings right here. You can see a big gap down in the stock. And one thing I forgot to mention is that these gaps, you want to see them on big volume. And this, I don't know if you can see this light red bar here, that shows the volume. You can see it's much higher than the volume of the previous days. So when you have a move, when you're studying price action, you always want it to be confirmed by volume, by extra high volume. And if we look at an intraday chart of this, it's very similar to what ANF did. CPRI. The stock gaps down. You can see it gaps to new 20-day lows. Again, we'd wait for the first 15-minute bar. We'd go short here. And then we'd either exit at the end of the day if it was a day trade, or we can hold it for a multi-day swing trade and let the post-earnings announcement drift just take us lower. And again, you can set your stop if it's a day trade at the high of that first bar. This is how I trade earnings. This is a much better way of doing it than jumping in before the earnings are reported, because you really don't know whether stock's going to move up a lot or down a lot after earnings. Much better to let the market indicate the direction, and then you can sort of surf along on the waves created by the big institutional investors. Now, if you found this video helpful, you'll love my book where I talk about lots of strategies like this. It's a new bestseller on Amazon. It's called Beginner's Guide to the Stock Market, and I'm going to stick a link to it in the description notes below. And for this weekend only, it's going to be 99 cents. So it's almost a 100-page book, tons of strategies like this, and quite useful whether you're a beginning trader, investor, or you're intermediate, or even advanced. I have some advanced strategies in here as well. So if you enjoyed this, check it out. And also be sure to subscribe to my YouTube channel. And please leave me some suggestions in the comments below as well, what you would like my next video to be about and whether you found this helpful or not. Thanks a lot for listening. I'll see you in the next video.